Hello and welcome to episode 366 of the Money to the Masses podcast with your resident expert. As always, Damien Fay and me, Andy Leaks. Damien, we're back. We're here again. How are you doing?
I'm very good. We've had a busy week this week. But before I talk about what we've been up to, one thing I just wanted to mention on the podcast, which is a bit of a proud dad type thing. My daughter last week, it took me a few days to get over the fact that she played in her football team and they beat Arsenal. Obviously, if you listen to this podcast, you will know I'm a Spurs fan. So I enjoyed it. I mean, more importantly, she enjoyed it. But they beat Arsenal's girls team over the weekend and they're now in a final this week. So that was brilliant. That was a great start to the week. And in terms of work-wise, we've been incredibly busy. I mentioned on last week's show about the changes that we may be doing or we are going to be implementing regarding content in the changing world we are in, especially given the cost of living crisis. And a number of you wrote in to give your views and opinions about that potential change. Linda, for example, thank you for your lengthy email that you sent in where you thought about the pros and cons and gave your view on it, which really helped because we all sat down this week in the Money to Masses offices and had a bit of a brainstorm around the direction of some of the content that we're going to produce, which included things like midweek markets and also the cost of living content. How we're going to serve you all with the content that you want, need, what platforms will we use? And so please keep sending that feedback and your views on that. It may be that you've particularly valued midweek markets. For example, I've had a few people write in about that. Like I said, it's on holiday at the moment. We've not made a final decision on what we're doing with that show. So please make sure you have your say. Send in an email, damien@moneytothemasses.com, or you can email Andy's, which is andy@moneytothemasses.com, to give your views about what you'd like to see on not just the podcast, but all the platforms we use, including social media channels like Instagram. But before we continue with what's on this week's show, please also send in your reviews of the podcast. It helps us in those charts and it's incredibly motivating for the team to read them. So let me tell you what's on this week's show, Andy. First of all, I'm going to do an investment piece about the equity bond correlation that happens in markets. So when you build a portfolio, traditionally, portfolio diversification has been largely equities combined with bonds in varying quantities. And there is a question as to whether a bond equity portfolio, whether that combination or that type of diversification has had its day. So I want to do a piece on that. Then Lauren is coming on the show because Lauren is doing a piece on travel insurance when you have pre-existing medical conditions. Now, she's been working on this in the background and I found it incredibly useful because I've needed to get travel insurance with my pre-existing medical conditions. In fact, it won't take a genius to work out that the example that Lauren is going to use is probably based upon me in her piece. And so I realised that that's got a lot of value. So listeners of the podcast would find that useful this year when they're booking their travel insurance. And the final piece, Andy, you are going to do a piece on devices.
Yeah, they call them vampire devices. It's a term that's been coined on devices that are left on standby mode and actually how much they are costing families on average per year. So there's a piece of research by British Gas and they've updated that piece of research to take into account the latest prices of energy. So it's interesting to see how much those devices are costing. It's just a quick piece at the end, really. So you can yourself go around your house and, like a mad person, which I've already just done because I wrote the piece, and switch off all your devices overnight. So
it'll be interesting. I've not heard any of that piece. So I will be doing that after the show, going and turn off and probably nagging my poor children and my wife to turn off the devices. So let's kick off with the investment piece. Now, last week I did a piece on gilts and in particular inflation-linked gilt. So they are a type of gilt that people might be attracted to in this high inflation environment. But my piece last week explained why that might be the wrong thing to do because they don't provide the protection that you think they would. Now, I got some great feedback about that show because lots of people said they never really understood how inflation-linked gilt worked. But this week, I'm taking that on one step further because bonds and equities, I touched upon it last week in the show, that they've been falling as of late. So if we look at the year-to-date figures, I'm going to read a few of them out. So Let's focus on equity markets. Now, equity markets have struggled this year. The one that really hasn't has been the FTSE 100, which is up 1.6% year to date. So this is as at the end of April, pretty much. Now, if you look over in America, the Dow Jones is down 5%. In Japan, the Nikkei 225 is down 7.37% year to date. As a broad measure, the MSCI All Country World Index, which is just a broad measure of global equity markets, is down almost 10%. The S&P 500 is down 10%. Emerging markets are down around about 11 to 12%. Asian markets are down around 12%. The German DAX is down 13.5%. And the NASDAQ 100, so the very tech-focused NASDAQ in America, is down 17.5% year to date. So the message is, despite the ups and downs we've enjoyed, because there have been some rebounds, equity markets are struggling in 2022. And we saw a little bit more weakness this week. So how are bond markets doing? Well, just as a broad measure, the average global bond fund is down around 4.5% year to date, while the average sterling corporate bond fund, so their UK bonds, is down around 7.5% year to date. So if you've got a bond equity portfolio, then you are sitting on some significant losses year to date. And in fact, the 60-40, 60% equity, 40% bond portfolio has had probably the worst start in its history this year to date. So there'll be a lot of people out there who are maybe even passive investors that might have bought things like the Vanguard Life Strategy funds to sit there thinking, this is just falling year to date. And does that mean that the bond equity portfolio is dead? So that 60%, 40% mix, which is incredibly popular, is that it? Or are we going to see some kind of reversion to the mean? So are we going to see that type of portfolio working again? And what's happened year to date is that bonds and equities are moving in the same direction, which is unusual. Now, you do get periods like we are having 2022 where bonds and equities move in the same direction. So as equity markets fall, bond prices fall as well, and you don't get that diversification benefit, because normally most investors will have seen that bonds tend to fall when equity markets rise and vice versa. So they provide a bit of diversification. And we do get bouts where that correlation breaks down. So typically we'd have a negative correlation between bonds and equities. They move in opposite directions. Now that has started to break down this year, and that's not unusual. You get periods where they become positively correlated, but then you tend to get that reversion back to that traditional negative correlation where they move in opposite directions. So in a market where equity markets crash, people tend to flee and buy bonds, and you see those pick up. Now, we're not seeing that at the moment. So it begs that question, are we going to see that reversion to mean? But interestingly, Schroders, who are an investment house, carried out some research, and they looked back as far as 1926 and looked at the correlation between bonds and equities. And in fact, the negative correlation that we all are used to has been a relatively recent phenomenon, and that has really been in existence for the last 20 years, so since the turn of the century. If you go back and look at history, there are distinct periods where bonds and equities become positively correlated, then periods where they are negatively correlated, then back to positive and then negative. And in fact, if you look at a chart, which I will put a link to in the show notes, and I will put the image in the post that we have on the website for this particular episode, there have been 4 distinct periods where bonds and equities have been positive or negatively correlated. And to give you some context, between the late 1960s and the late 1990s, bonds and equities were positively correlated, which means they move in the same direction, whether that's up or down, or in other words, behaving just like they are in 2022 so far. So it's not that unusual. You'll get whole periods where the relationship changes. So does that mean that we are now in that period? Now, the research from Schroders concluded that when investors are worried about slowing growth, so slowing economic growth and high inflation, and that's called stagflation, so you get stagnant growth and high inflation, as they were in the 1970s, then they tended to end up disliking both equities and bonds at the same time, instead favouring cash, which caused the equity bond correlation to turn positive. So they basically didn't like bonds and equity, so they fell in tandem. So that correlation is positive. And furthermore, if central banks started raising interest rates at the same time as economic growth is slowing, then history shows that this also coincides with a positive correlation between bonds and equity markets. Now, if you've been listening to that, you will sit there and think, this sounds very much like 2022. And of course, that is what we had back in that period, the 1970s, and we're starting to get a similar environment developing in 2022. So perhaps we shouldn't be surprised that the correlation between the two assets has turned positive. And so a simple bond equity portfolio has started to produce this negative return because it has done in the past. And if you think about it, the portfolio construction that goes on in the investment world has been based upon recent history when we've had lots of QE, for example. So the last 20 years, the bonds and equities did diversify a portfolio pretty well. Now they're not. So the realization is that we've got to be open to the idea that the world might be changing, that bonds and equities might move in the same direction, either up or down. And it means that the portfolio construction we've been used to for the last 20 plus years might not work as well as it has done in the past. And what was really interesting is Schroders took that research even further, and they found that when inflation exceeds 3% a year on a 5-year basis, then that equity bond correlation was positive 98% of the time as far back as 1926. Now, if you think about inflation at the moment, we are in a high inflationary environment. So if that continues, the message, according to the research that Schroders has done, is that we can expect the correlation between those two assets to be positive over that longer term. And that will mean that a pure equity bond portfolio will underperform. And so that will be bad news for things like that Vanguard Life Strategy Fund that everybody loves, the different variations. And in fact, if you look at the versions that have the highest exposure to bonds at the moment, so the 20% version of that life strategy fund, the 40%, they've been pretty hammered year to date. So the message is we've got to be aware that we might be moving into this new environment. History suggests that if we do continue down that path, then what we've seen in early 2022 could continue for a period of time and can in fact continue for an extended period of time. Now, people listening to this might be wondering, well, why is that happening? Because if inflation is rising, yes, that means interest rates are likely to go up as central banks raise them to try and tackle inflation. Now that seems like that is obviously bad news for bonds, because don't forget, bonds pay a fixed coupon interest payment. So if interest rates in the economy are going up, then those fixed payments don't look as attractive. So people think, well, I won't actually buy bonds. But if economic growth is falling, then that's a good environment for bonds. So that seems a little bit confusing, because on one hand you think it'd be good for bonds, but on the other hand it isn't. And the reason why over the long term, as the research has suggested, that it can be bad for bonds as well, is because it's the dynamic of those two things playing out. And actually the higher interest rates start to impact bonds more, and it's about the rate of change in those interest rates, the volatility. And of course, we're in an environment where interest rates are suddenly expected to raise very quickly. I mean, I saw a headline the other day where one investment bank thought that interest rates in the UK could get as high as 3% by the end of this year. That is just one view, but that shows you we've come a long way in a very short space of time in terms of inflation expectations, and those expectations are what also move markets. Of course, if you look at equity markets, then you think, well, inflation doesn't necessarily have to be a bad thing, because some companies can pass on that inflation to their customers. We've talked about different sectors in equity markets that can still do okay in an inflationary environment. And of course, if we are in a period where economic growth is slowing, then that isn't necessarily great for equities, because if you think about it as a parallel, economic growth and profit for companies kind of go hand in hand. So if we're in a recession, company profits tend to be impacted. It varies between companies, but as a general rule for what we're talking about here, you can think that if economic growth starts to fall and decline, then that means profits will do, which means that equities become less attractive. And of course, if interest rates go up, really what an equity price is a discount of future earnings that you're likely to get from a company. And of course, if earnings might fall and that interest rate is going up, then the rate of that discount is greater, which means that the current share price is lower. So again, it's that interplay between inflation expectation, interest rate expectation, that volatility, and also how we think economic growth that might be slowing will hit profits that then make equities also unappealing in such an environment. So it doesn't mean that just because we are in this kind of stagflation environment that seems to be unfolding potentially, that both equity and bonds will do badly or will definitely move in the same direction. But history shows that more often than not, that is what we get.
That all makes sense. And obviously it's a bit of a confusing times, probably for investors and no doubt fund managers too. So what's the solution? Where do we move now? And are the fund managers scratching their heads and trying to find that magic mix?
Yeah, so I carried out a piece of research for 80/20 investors this week, and its aim was to try and work out, well, what do you do in an environment like this? And given that the environment that we're in has only unfolded really in 2022, it's quite a short period of time to work out correlation, so how different assets move with each other in this period of time that we've had. And don't forget, there's been other things in there as well, thrown into the mix, a bit of geopolitical concerns as well that always shake markets. And so you could think, could we look back to the 1970s? But it's quite difficult to get some of the data for that. So what I did actually was look at some of the permanent portfolios or perfect portfolios as I've made for 80/20 Investor, portfolios that have been designed to try and weather any storm. And there's some well-known ones out there. Ray Dalio has a portfolio. Harry Brown has done one. We've done a podcast that covered all of these. In fact, it was podcast 278 where we looked at the best all-weather portfolios. Now, these portfolios are designed by different people with different views on what assets to hold over the longer term, and they go beyond the basic bond equity split. And so what I did is look at which of those portfolios had done well in the current environment year to date, because they could give you a hint as to the types of assets to maybe look at if this environment continues where we're getting bonds and equities moving in the same direction. And I won't give away all the research, but what it showed that in a period where we have a sustained positive correlation between bonds and equities, so they no longer diversify each other as well, having more cash in your portfolio is a positive thing. Looking to invest in gold is a positive contributor to performance. Possibly exposure to commodities as well, because I know gold is classed as one, but commodity is a different type of asset. Again, there's that sweet spot where if growth slows so much, then the demand for commodities from an economic standpoint can start to fall. So actually commodities can get hit. And maybe you look beyond bonds. You start looking at things like targeted absolute return funds, and you limit your equity exposure as well. So it's a very different portfolio to what we've been doing maybe over the last 20 years. So the message for this part of the podcast is that you might have to start thinking outside of the box if we continue to have headwinds for the simple bond equity portfolio.
Okay, so let's move on to the next piece of the podcast then. And we're going to be welcoming Lauren, our senior consumer writer, back onto the show. And she's going to be talking about travel insurance and specifically travel insurance with pre-existing medical conditions.
Yeah, so if you are looking to get away this year or you have already booked your trip abroad, then you may be thinking about getting some travel insurance. Now, according to the ABI, which is the Association of British Insurers, in 2019, travel insurers paid 471,000 claims worth a total of £377 million to travellers who needed help whilst they were abroad. 197 million of this was to cover the cost of emergency medical treatment and £141 million was for cancellations. But despite this, in 2019, ABTA, which is the leading association of travel agents and tour operators, found that 1 in 5 holidaymakers travelled without insurance, and over a third of those holidaymakers thought that they didn't need it, and others said that they were willing to take the risk to travel without insurance. Now, one of the main risks of travelling without insurance, and something that I have found and become quite passionate about since looking into travel insurance a bit more, is the high medical fees that you may incur should you fall ill and need treatment whilst abroad. Now, not even if you are ill. if you have an accident, if you fall over, anything can happen whilst you're away, any unexpected occurrence, and you could face some high medical bills. Now, I've got some examples of the cost of treatment whilst you're abroad. So those people that are thinking of taking a risk of traveling abroad without travel insurance may want to think twice when they hear these figures. So there was an example that the destination of Spain, someone broke their leg and they required hospital treatment, and the cost of this treatment and flights back to the UK came to a total of £15,000. Now, another example was Greece. Someone had a quad bike accident that required surgery. This came to a total of £30,000, including flights back to the UK. If you're travelling further afield, you're going to America and you have a stomach bug, which requires hospital treatment, this could set you back about £100,000, which obviously most of us don't have in our back pocket, which is why travel insurance is so important.
Blimey, that's crazy. I mean, £15,000 for a broken leg and then £100,000 for a simple stomach bug in a place like America where they've got the private hospital system over there. That's crazy.
Yeah, and these are just for accidents or anything unexpected that happens whilst you're away. So it could be even more expensive if you happen to fall ill whilst you're abroad, if you have a pre-existing medical condition, which is what I'm going to talk about today. Can you get cover for pre-existing conditions if you're traveling abroad, and will your travel insurance cover you? So the short answer is yes, you can get cover for your travel insurance for pre-existing conditions, but this does depend on the particular condition and the severity of the condition. So if you are looking to take out a travel insurance policy, it's imperative that you declare any pre-existing condition that you have. Now, I'm just going to let you know what insurers class as a pre-existing medical condition. And this does vary depending on the insurer, but as a general rule, a pre-existing condition is defined as any serious medical condition that you have had in your lifetime, e.g. respiratory problems, heart problems, or cancer. Any condition that you have seen a doctor for or received treatment for in the past 12 months, but for some providers, this may extend to 24 months. And any medical condition where you're awaiting test results or for an operation. So therefore, if you have had any kind of medical condition in at least the last 24 months, then it is important that you declare it when getting a quote out for your travel insurance. And not doing so can mean that you may not be covered when it comes to making a claim. So if there is anything that you are unsure about whether you should declare it, I would recommend contacting the travel insurance provider just to double check to make sure that the condition is covered.
Right, and on that, so if someone's thinking, oh, that was such a minor thing, I don't think I'll bother putting that on the forms because it's too much fuss and I can't remember the dates. That's not particularly the best advice, because you've got to assume, therefore, that if it's been noted, if you know that you've had that, it's just not going to be covered. So why take the risk, right?
Yeah, exactly. And that comes to another point that I was going to make, that the best time for you to take out a travel insurance policy is as soon as you have purchased your holiday, and it can potentially work out cheaper the sooner that you take it out. But the most important part is that you are covered immediately if for some reason you cannot travel. Now, this is particularly important if you have a pre-existing medical condition, because should you have a flare-up of the condition before you travel and you therefore need to cancel your holiday, then you will be protected and you can claim on your travel insurance policy because you need to cancel the holiday. But one thing that this brings me on to as well is if you've taken out the policy as soon as you've purchased the holiday and then you develop an illness which you did not have at the time of taking out the policy, you will need to declare this to your travel insurance provider and make sure that you are still covered. And as a result, this could affect your travel insurance policy. Now, this leads me on to if you can get cover for your pre-existing condition. So I said the short answer is yes, but it does depend on the condition and severity. So when you contact the provider and let them know the pre-existing condition, you have to fill out a medical screening form when doing an online quote. Now, this will then determine whether you're going to be offered cover from the travel insurance provider. Now, the conditions are typically classed as serious or non-serious. Now, a serious condition is something that you may need treatment for whilst you're away, or it may flare up before going, which results in cancellation costs. So an example of a serious condition is a terminal prognosis, a cancer, particularly if you're receiving treatment, and any kind of respiratory condition. And a less serious condition could be an example of something like mild asthma, because it could be deemed as being well controlled by medication. So the type of condition that you have will determine how much you are going to pay for your travel insurance, but it will also determine if you are going to get covered. So typically, if you go to take out a travel insurance policy, your travel insurance provider may offer to cover your pre-existing condition, but may charge you an enhanced premium as a result. You may also be able to get travel insurance for your trip, but they may exclude cover for your pre-existing condition. They may completely refuse to cover your pre-existing condition, so they may not offer you travel insurance at all, or as previously mentioned, if you have already taken out a policy and then you let them know about a new one, they may cancel your existing policy or amend it due to the pre-existing condition that you have declared. So this leads me on to what kind of providers offer you cover for your pre-existing medical conditions. Are there any specialist providers? Because if you have a serious condition, you may need to speak to a specialist provider about getting cover. Now, there's a few insurers that try to provide cover, and a lot of these, like I mentioned earlier, do an online screening process when you go to take a quote. So these are the likes of Stayshore, Holiday Extras, All Clear, the Post Office, Virgin Money. Insurers like that like to try and offer you cover for your pre-existing conditions. So when you go to take out a quote online, you'll be asked a series of questions about your pre-existing condition, and then you will be notified if they are going to cover you.
And on that, Lauren, then, is that an immediate process online? Are you speaking to an advisor via a chat window, or is it a case of, we've got your details, we'll have a look at that and we'll contact you back? Is it by phone? Is it by email? What's the general process, or is it different depending on which provider you go to?
Now, it can vary depending on the provider, but some of those providers that I have just listed there, they have an online medical screening process. So you literally just go to make a quote as if you were going to normally, and then they ask you a question if you have any pre-existing medical conditions. If you click yes, you then have to declare the conditions, and then you get asked a series of questions related to the condition. So for example, if I was going to do it for my asthma, they ask me if I've had any hospital admissions in the recent years, if I take any regular inhalers, any regular medication, if I have a COPD, anything like that, if I need oxygen, and that determines the severity of your condition and whether they're going to offer you cover. Now, if they are going to offer you cover, it's likely that they will allow you to continue the quote process, and then you will be given a quote which covers your pre-existing medical condition. Now, if your condition is deemed as too severe by this particular insurer, they will notify you that they are unable to offer you cover, and they have to direct you to a directory of providers that specialise in travel insurance that will be able to cover you. Now, this directory is provided by Money Helper, and what they've done is they've put together a directory of providers that are specialists in providing travel insurance for pre-existing medical conditions. So if the particular insurer cannot offer you cover, then there may be an insurer on the Money Helper directory that can. But when you look at the Money Helper directory, it is important that you get a few quotes, because you can compare the high street travel insurers to some of the specialists to compare the different types of cover. Now, I have actually done a couple of examples just to give you an idea of costs that you can expect to pay for certain conditions. So just to give you a quick example, I've done a quote for a 20-year-old asthmatic travelling to Spain. Now, a 7-day single trip with the insurer Stayshore is $1,790. If you do the same 7-day single trip with Virgin Money, this is $1,550. But one key thing you have to consider here is the difference in medical cover. Stayshore has higher medical cover than Virgin Money, but it depends if you want the higher medical cover or the lower cost for the policy. Now, I've done a couple of other examples of different conditions just so you can compare the cost of what it's going to cost you if you do have a pre-existing medical condition and if you don't. So another example is a 30-year-old with diabetes. A 7-day single trip is $1,978, and this is with Stayshore. If you don't have any pre-existing conditions on the same trip, just a comparison of cost here, it would cost you £12.12 for the same trip. So I've got another example here. It's a 40-year-old with Crohn's disease. 7-day single trip to Spain, $67.51. But if you have the same trip with no conditions, it's £12.25. Now, these quotes are also with Stayshore. But if you have an annual trip, it's $135.95. So an annual multi-trip policy covers you for multiple trips throughout the year, but it does insure you for your pre-existing condition. But if you don't have any medical conditions, the annual multi-trip policy with Stayshore is £35.68. So that's just a comparison in the difference of the cost. But just remember that every single one of your trips that you take throughout that year would cover your pre-existing medical condition.
On that, Lauren, on the annual multi-trip policy, do you have to notify the insurer each time you travel? And does it cover you for travel within the UK? Say you took a short trip away for the weekend.
No, so all you need to do when you take out an annual multi-trip policy is ensure that every destination you're planning on going to is covered. So for example, if you take an annual multi-trip policy out and you take it out for Europe, but then you book a holiday for the USA trip wouldn't be covered because you need to make sure that you're taking a worldwide policy out that includes cover for the USA. So that's just one thing I would say if you're going to take out an annual multi-trip policy. Ensure that it includes cover for all of the trips that you're going on. But also you need to look in your policy documents because there are certain trip length limits. So you may only be able to go away for a certain amount of time per trip. So you just need to make sure you read your T's and C's because this can also vary depending on the provider. And some providers offer specialist travel insurance if you are going to the UK, but most of them would cover it. But just one thing, if you are traveling in the UK, obviously we are lucky enough to have the NHS here. So you don't necessarily need to take out travel insurance to cover emergency medical costs, but you would consider taking out travel insurance for things like cancellation due to your pre-existing condition. That would be a good example of why you would take out travel insurance in the UK. So just moving on to the final quote here that I just did one for a 50-year-old with prostate cancer. So this particular quote is if the person has been diagnosed with prostate cancer, but they haven't yet commenced any treatment because it's not yet required. So a 7-day single trip to Spain with Stayshore is $22.28. An annual multi-trip policy to Europe is $48.44. Now I did a comparison cost if you've been diagnosed with prostate cancer, but you're currently receiving treatment. So you're currently receiving treatment for your prostate cancer and you want to go to Spain for 7 days. That will cost you $77.32. So I've compared the Stayshore $77.32 to another provider that covers prostate cancer. And that provider is called All Clear Travel Insurance. And for 7 days with prostate cancer whilst receiving treatment, it would cost you £105.53. So just a comparison for an annual multi-trip to Europe, whilst you're receiving prostate cancer treatment, with Stayshore, this would cost you £150.79. And with All Clear Travel Insurance, this would be £242.22. So that just highlights why it's important to shop around and look at different providers because there is a substantial difference in the cost of cover with the two providers there.
This is really interesting because you're sort of bringing up some fairly serious conditions here for people who aren't necessarily that young, 40 and 50-year-olds. There's something in me that maybe I'm too pessimistic, but I would say if I had a medical condition, a serious medical condition, I would possibly just think, oh, well, I probably can't get covered for that, so I won't even bother about it. I'll just take the risk. But what we're saying here is shop around, do the research, and yes, it is going to cost you some money. In some cases, a couple of £100, maybe several £100. But to know that you've got that cover and that you can enjoy that holiday, sleep easy at night and know that in the worst case scenario, if you needed treatment, the cover is there. I mean, there's nothing worse than going away for a lovely holiday, having to have some serious treatment and then come back to a severe medical bill. I mean, that would just be just a worst case scenario. It's really interesting stuff. And so what I'm taking away from what you've said here is obviously do your shopping around, speak to all the providers. There are providers there that you've mentioned that will do their best. But if you think you've got to a bit of a dead end there, don't forget that the Money Helper website has a list of specific providers that should be able to cover you in the event that you have a serious condition, which is really good to know.
Yeah, and just one tip whilst you're looking at the travel insurance directory is Money Helper does offer you the providers that will potentially cover your condition, but it also tells you who does the medical screening process. So whilst you're shopping around, you can look at who does the medical screening process and maybe go with a provider who has a different way of screening your medical condition, because then you're more likely to see a difference in the cost of your insurance and their likelihood of covering you. One thing to just mention before we finish up as well is there is a specialist insurer if you do have a cancer or a terminal diagnosis, and they are called Insure Cancer, and they are listed on the Money Helper directory. But also one thing you need to consider is a lot of providers may not provide insurance cover for you if you have a pre-existing condition with outstanding diagnosis, any outstanding results or consultation conditions, as this can be seen as a potential reason for you to need to cancel the holiday and make a claim. And also that's probably why, if you have a serious pre-existing medical condition, you may be paying a higher premium, because the insurer sees it as you are more than likely to need to claim whilst you are away. Just to finish on finally as well, if you are looking around and you are really struggling to get travel insurance for your pre-existing medical condition, there are a few things that you could potentially try and do. Is you could try to change the destination of your trip. This is obviously if you haven't already booked your holiday, or you may be able to contact your provider, or you could potentially look to change the length of your trip, as that may be able to help you to get cover. For example, it may be more expensive and hard to insure you if you're going to America, but you may be able to get cover if you're going to Europe. Or you could try to change the policy type. So it may be very expensive and hard for you to get an annual multi-trip policy, but can you get single trip insurance for your trip instead?
Brilliant stuff, Lauren. That's really clear. And I think there'll be lots of our listeners who are looking to go away and have probably booked their holiday already and maybe considering getting their travel insurance. There's some really useful tips in there. And Lauren's written a brilliant article that's on the website, and we'll link to that article on the show notes so that you listeners can have a little look at that. Lauren, thanks so much for coming on. Damien, actually bringing you back in. You've used Lauren's knowledge, haven't you, that she just shared there to sort out your own travel insurance.
Yeah, and it makes a huge difference if you know what you're looking for and the companies that will treat your condition more favourably. And I mean, Lauren's done some articles which we're linking to on the show notes. But the difference for me when I was looking around was about £1,000 on an annual travel insurance policy. So even the idea that you're spending more than a couple of hundred would make people listen to this podcast, their jaws open. But when you have a medical history that isn't obviously perfect, it can mean that you get charged a huge sum of money for travel insurance, even though the holiday itself isn't the most expensive holiday going.
And actually what was quite interesting, where Lauren's given that tip, which is a very valid tip, of getting that insurance sorted as soon as you book the holiday, as soon as you can, because then you're covered for cancellation. You held back a little bit, and actually that worked in your favour, didn't it?
Yeah, actually, I think this might be a tip for general insurance in this current environment. I had done a quote, was looking around and doing the research and listened to what Lauren was saying effectively. And then after a day or so, I started getting discount codes from the insurer who I ultimately did buy the insurance from. And they gave me, I think it was 15% off. And so if you're going to buy it, even if you wait 24 hours, then it could be you get it even cheaper. So they know that you've done a quote online on their website, then getting a discount code could make that policy that much cheaper, especially if you're paying quite a high premium. 15% on a decent sized premium equates to a decent saving. So that brings us on to the last piece of the podcast this week, Andy, a piece of research that came out this week. I've heard similar things in the past, but I thought it was a really good one to focus on now that we're all very energy conscious. And it was research that looked at how much it costs to leave certain devices on standby, and more importantly, which ones are the most expensive.
Yeah, so I've written a quick piece on the website. Again, we will link to it in the podcast notes. And so I'm going to list off the top 10 worst offenders. And these are devices that are left on standby and how much it's going to cost you on average per year. So the worst offender is a television. That's going to set you back about £25 if you leave it on standby overnight. The next one is your Sky or Virgin box. So those two pretty much come together. If you leave both of those on standby, that one is going to cost you £23 a year. So combined together, your Sky and your telly, if you're leaving that overnight, that's going to be about £45 a year. The next one is your internet router, about £18 a year. This one surprised me. Microwave, just shy of £17 a year if you leave that on standby overnight. Now, I mean, who switches off a microwave at the plug?
I've never switched off a microwave.
That's an expensive clock.
Well, my clock isn't even working because I've never set the time correctly, so that's completely pointless.
The next one is a games console. Obviously, lots and lots of children, even adults, myself, I've got one, leave a games console on standby because they do automatic updates overnight. So it just makes it easier by leaving it on standby. But that's going to cost about £13 a year. The computer is the next one, £11.22. Shower. Not many people have electric showers these days, but if you've got an electric shower, make sure that you actually turn it off. Most of them will have a switch that you can turn it off because that's going to cost you just under £10, £9.80 a year. The next one is a dishwasher, which surprised me. Much lower, it's about £7 a year if you leave that on standby. That's going to be tricky for me to turn off because I always put my dishwasher on last thing at night and I have it running. So I'd have to run that earlier if I was going to do that. And the final one is a tumble dryer at just under £5 a year for that. So if you add all that together, it's well over £100 that you're spending as a family on average per year just by leaving things
I
on
can
standby.
imagine going home and doing all those things at once and then just hearing screams and groans as my wife's in the shower and it goes cold and my children are on their devices and the internet just goes out. And I just think, yeah, we could do all of those. I think I will actually start doing one or two of those myself, particularly I think the microwave is quite a good one.
Yeah.
And we don't really use it that much often anyway, but also the TV and the Skybox, because again, we don't use the Skybox really anyway now. It's just effectively free viewing. Of course, the kids, they all just watch other sources online like YouTube anyway.
Yeah, I made the point in the article that, to be honest, everyone's not going to turn off all of these. It can actually be quite time consuming turning off all these things. But there are things you can do, for example. I definitely won't be turning off my internet router because I might need it in the middle of the night and it's nice to have it first thing in the morning, and I couldn't survive without my internet being powered up 24/7. So
and all your Alexa plugs and things wouldn't work.
That's it. You'd have to reset. Alexa would reset every morning. It'd be an absolute nightmare. And actually, me just saying that, I've probably set off some home devices there, so I do apologise. But there are a quick couple of tips if you want to make this job a little easier. If you've got multiple devices like the television and the Skybox, if you put those through one switch, one sort of multi-plug, if you like, it's just one switch to switch off at night. That's going to save you a bit of time and effort. And also, there are smart plugs out there that you can set up to do routines, so it would do the job for you.
So I'm going to say the word Alexa again to set up everyone's devices, but you can get Alexa smart plugs and power leads because I've got one.
That's it. And you set up the routines via the app and it will automatically turn off at a set time each day. I mean, there's a bit of an outlay to do. You've got to offset that with the savings you're going to make. But do you know what? It's made me more aware of what these devices are sapping in terms of energy. And I think I'll be a bit of a miser and I think I'll turn everything off.
I get up in the morning and the smart meters, I'm now fully paid up in the idea of having a smart meter. I know they aren't always the smartest of devices, given what happens sometimes when you change providers. Those things have improved. But I do look at my smart meter every morning and I do wonder why I've already spent £1.50 on energy when I get up and I've not even done anything. And part of that is obviously because of the heating of water and stuff like that overnight. But it does show you that some things do drain energy even though you're in bed. So I think that's quite a good piece. And I think a few people on that will change their habit based on that research.
That's it. So we're done for this week. If you want to get in touch with Damien, you can do so in the usual way. It's damien@moneytothemasses.com. Do send your ideas and opinions over, like Damien mentioned earlier in the podcast, about midweek markets and everything that we're looking to do towards the cost of living. Can we help you? Send us some ideas. And so that's it. We're done. Until next time.
Until next time.